So let me introduce Keshav to you. Keshav is mechanical engineer by profession. So he has done engineering from Delhi College of Engineering, or now known as DTU. He's a qualified actuary, fellow of Institute of Actuaries of India. Very relevant experience of around 1 decade. He has worked in health insurance companies and really worked on pricing. He's leading pricing of Niva Bupa Health Insurance, which is a standalone health insurance company. Now, getting into the topic of today's discussion, so a lot of time people really doubt whether health insurance is going to work in the long term or not. People cite examples, for example, let's say incidence rate increases by age. A person who is young may be claiming 3, 4 times if there are 100 people, 3, 4 of them are claiming. But when you go to higher ages, the number may be 30, 40. Out of 100 people you insure, 30 may be claiming. So loss ratio really goes up. A lot of time they talk about medical inflation. Medical inflation is something which is annual phenomenon. You always see that the rates of treatment is going up all the time. A lot of time people also talk about loss ratio increasing by age cohort, which is like policy age, and really doubt whether this is really going to work or not. But the same thing I have been hearing for last 15 years. So 15 years back also, when we used to have these session, people, used to say, okay, looks like you are sitting on a ticking time bomb. That was the thing. So idea of this session is also to debunk some of these facts and present to you some analysis, some data. This is not data of any particular company, but this is model data which is representing inpatient insurance, health insurance, portfolio. So now let me invite Keshav to further present his slides, and later on we can cover slides in next 15 minutes, and then we can discussion. We can have discussion, and happy to be challenged. Feel free to ask question. In between also, if you want any clarity, please you can stop us and ask question. Keshav, over to you.
Thank you, sir. Am I audible till the back? Great. Thank you, sir. Thank you for the kind introduction, and thank you for setting the context of this presentation that we are going to undertake. All right. So to begin with, like the world of actuaries, let's get straight into the data, straight into the charts. So this is what we are trying to showcase, what sir also mentioned, how the incidence rate varies by policy vintage. So by policy vintage, we are talking about whether it's a new business at this point, first renewal, second renewal, and then so on. So generally, what we see is the way health insurance products are designed. You see a jump in the incidence rate from the second year, third renewal onwards because of the exhaustion of the waiting periods that are there. And towards the higher vintages, it then goes on to stabilize. Right? The next one is the policyholder age. Quite straightforward, quite straightforward in terms of as the age increases, the incidence rate will also go on to increase. This particular phenomena is something which is taken care of by the rating variable of age in the pricing charts. So like most of you would be aware, age is something which affects your health insurance premium throughout your life. It's not about the entry age. It's about your age at every renewal, at every instance when you renew your policy, right? So this is something which we take care of by introducing age as a rating variable. This particular chart is an interesting one because this shows you a claim cost index of indemnity portfolio for an organization. So when we are looking at a 6-7 year view, we see that there is roughly 6.6% CAGR, which means there is roughly a 6.5% medical inflation that we have to take care of, be it into our base pricing, our new product pricing, or be it through any of the price revisions or subsequent price revisions that we might have to introduce in the portfolio. So to sum it up so far, what we are saying is that there's an increase in IR with vintage, which stabilizes at a certain point of time, from maybe renewal 5 or renewal 6 onwards. There's an increase in IR by the policyholder age, which is taken care by introducing age as a rating factor. This is something which is a challenge and which is usually addressed through periodic price revisions by companies across the country, in fact, across the globe, right? So this, moving on from this, so this was the same chart that you had previously seen. Now this we will get into a little bit more depth of. So when we are talking incidence rate, there are primarily two components which we are currently looking at. The first one is the infections only incidence rate. So these are only those claims which are driven by infections, bacterial infections, viral infections, the dreaded term in the health insurance industry, COVID infection, right? So if you see, this is something which is not your age-dependent function. This blue, this is the COVID year, so you can see the anomaly. Other than that, you will generally see, apart from 0 to 17 and above 70, that could be because of a little noise, but this is something which is not a function of age. Infections can happen to anybody, anyone having exposure to maybe water or to air, waterborne, airborne infections, could be anything. This is the chart for non-infections, which is dependent on your age. Non-infections, we are talking about things like cardiovascular conditions, digestive conditions, your urino conditions, which are your kidney conditions, stuff like that, right? And all the other conditions which are categorically not infections. So if I am looking at this age chart, it gets only more steep when I'm looking at the non-infections chart. So in the nutshell, why I'm showcasing this particular bifurcation to you is, whenever we are doing any kind of portfolio monitoring or any kind of analysis on how our retail books or how our group books have been performing, we generally start off with having a look at age. It makes more sense, it gives you more insights when you remove infections from that particular analysis, because that actually gives you a true reflection of how your portfolio is behaving by age. So like the theme of this particular presentation is that how we can actually leverage the longitudinal data. So this is one particular case of how actually the details, how actually the devil is in the details. The entire piece that we are showing here, this is for second renewal onwards, so that there is a stability in terms of the incidence rate that we are seeing. Infections will roughly form about 15 to 25, 30% of your claim book. So once you remove those particular chunk of claims, you get a real view of what is happening in terms of different conditions and different diseases in your portfolio. Now, this is one of the very interesting case studies which we had particular seen. What this chart shows you, it shows you for a mid-aged life, 36 to 45. That is where ideally, if you have a health insurance portfolio, your median age should be somewhere here, 36 to 45, right? And when you have a look at the disease-wise mix in terms of like count of claims that have come in, these are all non-infection claims. So when you have a look at these disease-wise in terms of what is contributing to your claim book, you would generally see that there would be some claims, a big chunk would be genitourinary. These are all CKD claims, your chronic kidney disease claims, which are dialysis claims and etc. Another big chunk that is there, that is now evolving from the look of it, is the bottomest one, which is the cancer claims. The first person view or from the first look of it, it feels like from year on year, the count of claims of cancer is increasing. That cancer is probably strengthening its grip on the Indian ecosystem, right? But when we look at it from a deeper point of view, the question is whether or not cancer is actually doing that. The answer is no. The count of claims is actually going up because of the higher number of chemotherapy claims. The number of people contracting cancer is more or less still stable. So, like I mentioned earlier, the devil is in the details, and that is what the longitudinal data can actually gives you insight into. When you get into those data, that what actually the trend is. Another thing is that you have to be mindful while looking at these trends is the medical, yep. I'm saying I was just coming to that. So next thing is in terms of any change in the medical management which is happening. So for instance, it could be the case that earlier the only two options were chemotherapy or surgery. But with advancement in technology, there is an option of chemotherapy and surgery, or perhaps a new thing, which could be maybe an increase of cases like oral chemotherapy, or it could be something like a radiotherapy, which has now been introduced. So any advancement in technology is something which might also be leading to this particular trend. So that's where I think the basic thing comes in, ki data does not data can actually tell the story that you want it to. For instance, if I show it to my claims head, so the person with a good scientific medical knowledge, we are the data people, he's the person with the medical knowledge. He might say that this is because of a certain medical advancement that has happened, right? So this is where you have to marry the data with the domain knowledge as well.
I just want to add one point to your question, whether number of cases of chemotherapy are increasing or not. So in this kind of data, so who will take chemotherapy? For example, somebody who was diagnosed in first year will take only in, let's say, in half of the year. The same person will take in second and third year also, may take. Then you will also add those who will get diagnosed on the second year. They will also take, let's say, second year, third year, and some part of fourth year. So what happens, even if the number of people who are diagnosed cancer first time remains same over the year, the number of chemotherapy claims may show increase. Because, it's cumulative. All those who got diagnosed are taking chemotherapy. That's the only point.
So this is not company specific. This is a model data. So like this particular view that you're getting, this has been curated to highlight the point that while it might look like that the number of chemo claims is increasing, this might not actually indicate that prevalence of cancer as a disease is increasing. So the entire slides that you are seeing, this is all based on model data, specifically to capture the trend. So for example, this particular thing, when you look at this age-wise data, this essentially captures the trend. For any organization, it might be a notch above, notch below at a certain point. But this generally captures the trend that you see across ages, across vintages, or any such thing. Yeah. Dialysis chronic CKD is one of the components, but genitourinary will encompass other things as well. So, for example, it could lead to maybe your stone conditions would also fall, I think, would also come into this particular category. Yeah. All right. So
I think he has some, yeah.
Can you go to the slide which contained infection once, the infection chart based on age?
this one?
So in the earlier ages, the immune system is not that developed. So could it be possible that in the earlier ages between 0 to at least 14 or something, when we are still adolescent, when we are transferring from adolescent to adults, so could it be that number of infections and number of cases due to infections could be higher? That is why the morbidity curve should be this and then increase.
Definitely. So if you break down the 0 to 17, so generally for practical purposes, you will see for it broken down into something like 0 to 2 or 0 to 3. That would start from probably here. So it dips after a child is 2 years, 3 years of age.
Right.
Then it stabilizes till about 16, 17 years of age, and then you get this kind of a trend.
Okay.
So I have not introduced that particular condition, that particular age bracket here.
Right.
Because like the focus of the slide or the message that I'm trying to convey was not on that. But yeah, when you look at the actual trend, so this number actually starts from here and dips.
Because we need to, as someone who's selling health insurance, we would need to focus on the initial ages as well, right? Because
Yeah.
at the initial age, when there's a high probability of person getting infected, so the claims at that age are also higher, right? Like maybe somewhere between 2 years or 3 years or something, if parents have done a health insurance of the newly born child or something.
Yep, yep. See, yeah, then there is also a practical consideration. For instance, if let's say if I have a kid and somebody tells me for the first 2 years the premium is 5K, then it drops to 4K, and then after 18 it increases again. As a business, I might as well say, ki, yaar, I'll charge 4200 for 0 to 18. Right? That premium differentiation for such a small age might not be worthwhile my efforts.
Okay.
Plus, this particular case, 0 to 18, in the initial years, there's a risk, but then that's a good risk for me. From age 3 to 17, 3 to 25,
Right.
35, till the person is reaching ages where the prevalence of diseases actually increases. Yeah, 45 plus. That's a good risk for me.
Right.
So even if I have to say I lose money on the first 2 years of a child, I'm happy to do that.
Okay,
I have that
is
person with me in my books for a very long time as
so
a
you
good
you
risk.
are doing that to make your product more marketable in that case.
Yeah, yeah. That's what I'm saying. From the pricing point of view, one might say that. But from the pure risk point of view, the incidence rate for 0 to 2H would be little higher than 3 to 18, or like even if you break it down into multiple ages.
Right. That does make sense now. Thank you.
Right. So, having looked at some of the trends, we are just going to dive straight into what are the opportunities for innovation with the kind of data that we have now started capturing, we now have availability to, we now have access to. So the first thing that comes is personalized health plans and pricing, right? So especially when we are looking at pricing of the group portfolios, we can have dynamic pricing models where the premiums actually can vary on a day-to-day basis between different groups. We can categorize our customers into different risk stratas. Currently, if you look at the industry, we are talking about ages, we are talking about sum insureds, we are talking about maybe 1 zone, 2 zone, 3 zones in a product. But with the kind of data and the preceding session to this, like they mentioned about spatial smoothing and geographical spread, we might as well go ahead and say, ki, okay, let's have not 3, not 4, but let's have more zones into the pricing. That is just one of the things, but we could introduce something more as well in terms of risk stratification on the basis of data. Person's medical history is currently being captured, but we can have a granular look at that as well, that how does that particular person's medical history translates into the claims experience for a person, right? So this is from the product and pricing point of view. Another thing which actually holds more value is the emerging diseases pattern. Are there new conditions which are taking prevalence? Are there new infections which are going across, right? What can I do to actually prevent those particular things? If I am seeing a person aged 45 who has had a certain kind of a condition happen, is more prone to a subsequent condition in the next 3 years. I know from my data. If I get a claim from that particular person, I can actually inform the person, sir, you have a chance of a claim in the next 3 years perhaps. You can do certain preventive measures, you can take certain preventive measures. What that does is, it unlocks values for the customer, it sends a message to them that I care, my company cares. It helps me on the save on the claim cost, right? It's a win-win for both the people, right? Then there can be things like claim optimization. When I talk about that, what it means is, the biggest challenge that the industry faces is the provider arrangements. If I can forecast my claims well, if I can actually go on to say that I'm expecting certain claim cost from these conditions to go up in this particular geography, I can approach the providers, I can have good arrangements with them to take care of those particular conditions. I can run probably wellness programs for certain conditions, which I'm expecting to probably go up. Then the next thing that comes is behavior nudge. So for instance, I can actually go to my customer and I can tell them that, sir, based on your risk profile, if you make these certain changes in your lifestyle, there is this kind of a value unlocking you get. We went to, like, if we go to a movie hall, they'll show you an ad, they'll show you that within 12 months of smoking, quitting smoking, your probability of getting a heart condition reduces by 50%, right? So what that ad does? At the very first instance, the feeling we get it, kya yaar, kyun dekhna ye ad, right? But there, ultimately, I think even out of 1,000 people, if it motivates one person to probably give up smoking, it serves this purpose, right? So if we can get those behavioral things, nudges in the data, that if you do this particular kind of a lifestyle change, you get this particular benefit. So it unlocks values on a holistic level for the entire population. Then we are looking at certain things which are more business driven, like in terms of customer retention. How can we retain our customer? How can we retain the good customer? Like, I think when you work into retention space or things like that, the biggest question that you asked is, out of 10, my 8 customers are good. How can I retain all 8 of them, right? And that's where the data unlocks values. You have significant techniques like you can run clustering models, you can do n number of things to determine or to ascertain how your retention strategies are working and what more or less you can do to particularly improve them. Yeah.
So, with respect to the other operations, I mean, those are things that can be easily tracked. For example, like the claim settlement, the claims with things forecasting with, or the opportunities under preventive health care, where maybe things can be, it is easier to assess whether there has been a change or not. But in case of a behavior nudge, how, I mean, I'm just thinking out loud, like how would
Right.
any company actually track something of that sort? Like whether it's actually being implemented or not?
Good question. So across different organizations, at present, you will see there is a benefit which will give you discount on renewals on the basis of number of steps you have taken. Whether there's a relationship between the steps and the health condition, that's a topic for another discussion. But we generally say, like they will introduce it as saying something to do with staying active, right? Anything like that, staying active, living healthy, or anything like that. They will say that if you take these number of steps, you get a certain discount. To avail those discounts, you have to present that data, right? At the end of the day, if I have n number of customers, 100 customers, if I am giving them nudges to make little lifestyle changes, right? It might not reflect in my claim book straight away, but I think in the long run, these are something which, as an organization, when I'm doing, I'm not incurring a very significant cost, right? When I'm printing the policy copy, when I'm sending them the policy copy, if I'm adding a paragraph on best practices, right? So these are the things, I'm not incurring any additional cost, or the additional cost incurred is very marginal, very small. But the benefits it can unlock might be huge in the long run of things. Or at the end of the day, somebody might just actually read, ignore, move on. Somebody might take a learning from them. But if I can prevent even one claim or one condition which can be life-threatening based on those, I think the purpose is served for that particular message to be there.
So there can be interaction between loss cost as well as the retention. So like the people having very high loss cost and very heavy retention as well. And you have to, identify the segment which have, low loss cost, and you want to increase the retention there. So those models, like, do they have the capability to predict that interaction as well between the loss cost and retention?
Yeah, I think it can. You just need to probably introduce loss cost, maybe something like loss cost and your pricing, a ratio of that as a rating variable. So for instance, if a loss cost is 5,000, your pricing is 6,000, you get a ratio of 85% or something. You introduce that as a variable into your retention models, and probably it can serve you. It can tell you, okay, if your pricing by loss cost ratio is 30%, 40%, your retention is actually low. As it goes up, your retention increases, and then you can see by slicing and dicing like what kind of customers it actually does not impact, what kind of customers is actually it might have a better impact on.
Yeah, just to add, there are successful examples where you can predict the, let's say, next year's incidence rate and his probability to renew. And you're right, there is inverse correlation. Somebody who is really healthy, whose chances of claiming are less, so not inverse relation. So if we just say renewal, his chances of renewal are also lesser if he is not claiming. Somebody who is, let's say, chronically sick, so his chances of renewal are higher. So lapse is, with lapse is inverse relation, with renewal is same. So what companies are successfully doing is they are, let's say, doing 3x3 metric. So what are the customer segments where his incidence rate is going to be lower and his chance of renewal is also on lower side. So just focus your effort on that cell. So that can give you better results. And somebody who is, let's say, chronically sick, and it's not that you don't want to renew him, but anyways, when he is going to renew, you may maybe put less effort in that cell.
Effort, yes. Perfect. Thank you, sir.
Hello.
Yep.
So we are talking about retention here. Okay. So any insights on like why people decide to leave? Is it always they are looking for lower premiums or better coverage or inclusions, or what drives this lower retention?
Yep. Interesting question. I think that's I think I can have a 7-10 pointer slide on that. I think it's a thing motivated by a lot of factors. So for example, if I have got the customer through a push sale, if it's an agent who's giving me the customer, right? The customer's relationship is with the agent first and with me later, with the organization later.
Maybe I agree that the answer could be a very big one for this, but maybe you can cover the major factor or the top two factors that drive people to leave. Yeah.
Right. I think couple of big factors. First is the advisor push. So if there's a push from the advisor that the particular person is dealing with. So generally, if my agent calls me and tells me that, sir, it's better that you renew with this product now, I would not probably go into a lot of debate. I'll just say, ki, theek hai. What's the premium difference? Okay, I'll take that. I'll make that move. You do the necessary, you fulfill the necessary requirements. So that is one of the major reasons that customer would particularly move. And I think another thing which generally we have seen is, like sir was mentioning, that a lot of people might perceive that a person moved because of being dissatisfied by the organization. But in more cases or not, we have seen that if a person claims, the person actually does not move. Because ultimately, if the person has been given a claim by the organization, if the person has actually derived the value of the product once, the person would tend to stay with you, right? So another thing why a person moves is not because they are moving from one organization to another, it's actually the dropout. So for instance, somebody taking out a health insurance at a younger age, maybe 20 years, 25 years of age, they are not making a claim for next 4 years, 5 years. At a certain point, they just take that decision that, okay, let's not pay the premium itself. I've paid for 4 years, not gained anything, right? And I think another thing is...
Keshav, we are running short of time. You need to...
Yes, sure. So yeah, I think like you mentioned, maybe 2 points. So those would be the top 2 things for me in terms of why the customer leaves any organization.
Thank you very much. Yeah.
Yep, I think...
You can cover the last bullet and then we can...
Right. So I think just one last point that I had in terms of the presentation, so which was around outlier monitoring. So all our data, all our models, all our analysis will point towards certain desired results, right? But even the most beautiful or even the most symmetric normal distribution has a certain outliers, right? It has tails. So this is that particular point, like how we can actually leverage our data to monitor what kind of outliers are we getting. Is there any systematic trend to it? Outlier monitoring can then be further applied to things like fraud modeling, things like corrective actions that can be taken. Maybe some of the operational leakages that you might need to bridge in your particular organization and stuff like that. So that is probably one last opportunity from innovation point of view that I think is there. So.
Thank you, Keshav. So actually, we had a lot of questions, but if there are one or two more, we can take. Otherwise, yeah, there are two hands up. Yeah.
Yeah, so I have a question regarding the healthy incentives that you were giving. So I do have an approach in mind that we follow in life insurance reserving.
Okay.
That is impact calculations, like whatever changes are there in the policyholder status on a portfolio or on the complete business level, we calculate the actual impact of it. Like how is it going to impact our reserves? So could a similar approach be followed in case of such incentives where, because why we are doing such incentives is because we believe that there could be some impact on the morbidity of that individual.
Right.
So is there a possibility of such impact calculations happening in the industry, or if they are, like how exactly they are doing that, what factors are they focusing on?
Right. These calculations do happen. So when I say if any organization is giving you discounts, right? If they are giving you discounts in terms of number of steps taken.
Right.
So let's say the organization says 2 bands, 0 to 10,000 you get 1% discount, 10,000 plus you get 5% discount, right? If I give that discount for 1 year, at the end of the day, being a pricing actuary, I would myself be like, boss, I want to see the experience on this rating factor. Whether that 5% discount is actually worth giving or not. Am I doing that kind of a saving or not? At some point, it would have been assumption. But if I'm not seeing that converge from experience, I'll probably go back and say, okay, 1 and 5, nahi. I'll now do 1 and 3. I cannot withdraw it directly, but I can modify that particular thing, that how we can actually tweak that.
Makes sense.
Yeah.
Thank you.
We can take last question. Yeah, I think there.
I just wanted to ask, at what level of granularity should we actually stop? Like, let's say we are able to disrupt it to an extent that I can predict who makes a claim and of what amount. Should I only charge them who are making a claim? Where does the pooling of risk? And as an industry, we can discount the good risks all we want. We can't really levy a penalty on the bad risks. So are we not in the long run shortening our own market size?
If I only charge the person who is making a claim,
If I'm able to disrupt.
then I am the hospital, not the insurance company. No? So
No, you are absolutely right. So we have to really draw a line, and pooling of risk is the core. So, and most importantly, it has to be basis some objective criteria. So, basis is expected claim cost, you can't charge premium. Definitely agree with you.
Thank you.
Thank you. So we thank you, Keshav. Thanks for a very interactive session. Really.
Thank you, Keshav, for your timely efforts in providing guidance to us, along with Mr. Vishwanath. Indeed, a session we should not have missed. May we please have a loud applause for them.